All right, guys, in this video, we're going to talk about the BRRR method. It's a strategy, real estate purchase and investment strategy that can work super well. It's so creative. I love all these creative type of strategies. You can use this on residential homes or single family homes. I've also seen this used on big apartment complexes. So here's what it is. The BRRR method, it stands for buy, renovate, refinance, repeat. Okay, buy, renovate, refinance, repeat. It's a way to get the most out of your money and to stretch your money even further to get it doing more things for you. Okay, so what you do is first you buy a property, okay, and you earn your money on the buy. You may have heard that before. Is with any investment, you earn the money on the buy, okay, meaning that the deal has to make sense and you have to be buying at the right price. Okay, that's paramount. You're not just going to invent value out of nowhere without a plan ahead of time. So you earn your money on the buy, but you go and buy a property. Now, depending, again, you might have financing lined up. Maybe it's hard money, a hard money loan that you have. Maybe it's your own cash. Maybe you're using a home equity line of credit or an S block or loaning against your cash value, whatever it is, or you have a partner that has cash, whatever it is, you have the cash, you go and you buy a property, okay? Then you renovate the property, okay? So hopefully it's a significant value add. Maybe it's just a not great condition, good neighborhood, bad condition, okay? And so when you renovate, you have to be adding significant amount of value to the home above the amount that you are putting into the renovation. Just like a fix and flip, right? You put in $20,000 and you hope the value increases by 40,000, right? Same type of idea. You have to make sure that you can add enough equity and value into the home for this strategy to work, okay? But you renovate. Then you refinance. So what you do is you do a cash out refi. You get all of your money you put in, the cash to buy it and the cash to renovate. You get to pull all of that out, and you have to have at least 20% of earned equity still in the home, right? For this to work, because that's the minimum. You can finance 80% of it. So you've got to have enough equity that you can keep 20% inside the home. But if you do it the right way, you can pull all of the cash out that you put into the deal for the purchase and the renovation. You could get all of it back out. And just the earned equity, right? The increase in value based on your work is enough to meet that 20% requirement. Then you take that cash that you earned, right? You rent that property out. So you have zero money in that property, right? You essentially have a property for free. You don't have any money left in it. But you own the asset and it's growing and you have a renter and it's kicking out income, okay? Then you repeat. You take the capital that you used in that deal that you refinanced and got out and you go do it to another property. And you can rinse and repeat, do this over and over and over again, okay? So here is an example of that. So let's say there's a home, purchase price is $200,000, okay? Now again, the basis of the strategy is that you are adding significant amount of value. So this is going to be, an underpriced home because maybe it looks really ugly, it's in terrible condition. Whatever it is, you have to be able to add a significant amount of value. Okay, so it's important to keep in mind. But so $200,000 purchase price, you look around at comps, right, or comparable properties, and if they were in good condition, you see they're actually selling for $300,000. Okay, so you're buying this at a lower level because you're going to put in the money and time to bring it back up to the rest of the market, right? So you're saying, hey, other comparable homes, if I do this right, can sell for $300,000 or appraise for $300,000. Okay, cool. How much do I think it's going to go into this home to renovate it? I'm going to estimate $40,000. Okay, because you got to go in and just do a ton of work, right? There's a lot of work to do. So you get to $200,000. Again, however you get it, it's up to you. Loan against assets. You can loan against your 401k up to $50,000, right? Hard money loans, partners, whatever you want to do, but you have the cash. $240,000 is what you need. Remember, you go take the 200, you buy the property, you take the 40 and you go and rehab it. Okay, you renovate it. All of a sudden, once you're done with renovations, you go and get it reappraised. And hey, surprise, surprise, it reappraises for $300,000. So then what you do is you go and you finance the property because you have all cash in this at this point, right? maybe not yours, maybe somebody else's, but you want to refinance to get long-term terms on financing, okay? Preferential, lower rates, all that type of thing. So you go in and you say, hey, I want to finance this property. I want to do a cash out refinance. And you can pull out up to 80% of the home value, right, in cash. As long as you have 20% of equity, then you're good to go. So you go, it appraises for $300,000. You do the cash out refi. You pull out 80% of that money, which is $240,000, right? So $60,000 is left in there. That's 20% of the value of the property. That's earned equity though. It's not your own cash. It's earned equity. It stays in the home. You get your $240,000 back. Okay. You get a renter in there, happy. They're paying you money. You've got a $300,000 asset. Good for you. Now you have $240,000. If it's loaned out, right? You pay the loan back, right? If it's a hard money loan or a partner's or whatever, right? You can pay that back. If it's your own money, then great, it's your own money. Then you can just go do it again. So take your $240,000 or find another deal that makes sense, borrow the money or use your own capital, go do it again, rinse, repeat, refinance, cash out, refi, pull your cash back out. You've got an asset, you're renting it and everything like that. Okay. So the result is you own a property, it's cash flowing, it's appreciating in value, you own the asset, but you have none of your own money in it. Instead, you have more money, your capital back to be able to go do it again and again and again. Okay. Now, it doesn't always work out this perfectly, of course, right? This is just the idea and the strategy, and it does work, right? It works quite well. So I know quite well some people that did this in the commercial real estate space. So what they would do is they would go find distressed commercial properties, okay, that were maybe at auction, right? Or they were going to go bankrupt potentially, or they were getting foreclosed on. And so the bank was taking it and then auctioning it off. So they would go find these properties that were undervalued, okay? And what they would do is they would raise money, because this costs, there's millions of dollars in here and you have to go in with cash. So they would raise money from investors. Boom, they've got the cash. They go and bid at auction and they win the property. They're buying at a significant discount, right? Because at auction, you can get it at a low discount. Sometimes they didn't get it, right? It went above their number. And so they're like, yeah, it's not worth it anymore. But if it met their target and they're able to get the property, then they'd get it, okay? Immediately, what they would do is they would go and finance the property, because it's actually the value, the appraised value is worth more than what they bought it for at the auction. Remember, banks just want these off of their inventory. They don't want properties on their books. And so they're selling. It's just, if they get a good deal at the auction, they get a good deal. So then they would go immediately refinance the property. They would do a long-term financing. And in many cases, they were able to get all of their original money back out of it. Okay. So they buy the property at auction, right? Use investor money, buy the property at auction, go long-term financing, finance the property, do a cash out refinance, return all of their investor money plus a return that they had talked about, right, in advance. And then these guys would own the property outright. They didn't put any of their money in. And all of a sudden they have this massive commercial property, 50, 100 unit apartment complex. They own the asset, none of their own money in it, and it's cash flowing like crazy. Okay. So this is doable on a small scale or a large scale. Okay. You have to be able to put in the work and execute that plan, but it can work out to your advantage. And they did that many, many times. Sometimes they didn't refinance all of it out. Sometimes they, kept investor money in and just sent out distributions based on rental income. Just depends on the property and the situation, whatever makes sense. They would either keep it or sometimes they would even flip it and sell it. So anyways, a lot of ways to work this, but the BRRR method, buy, renovate, or rehab, refinance, and repeat, really creative way to get your money to stretch further. All right, that wraps up this video. See you guys in the next one.
Use your capital wisely.